A major stock crash could be coming in 2025, but most people won't be ready. If you take the right steps and you go into the right things that you need to do, you can protect your money and you can protect your wealth and even profit from this situation. Here's exactly what you need to do. I'm going to show you today what you need to do in order to do well if the stock market does crash in 2025. We see that we've had good movement all throughout the years, and it could get rocky. We never know. You don't want to be like this guy who's shaking in his boots because he doesn't know what to do. So here's what is not to do. Here's what you should not do. One, you shouldn't panic sell. You do not want to sell and just because you're scared because everyone else is scared and the market's going down. Because if you do, you would be locking in your losses. Now, if you hold great companies and have great ETFs that track the market, why would you need to sell? If they're great companies and great holdings that you've held all throughout the years, why sell now? Next, trying to time the bottom. Now, nobody can really predict how low the bottom could be, but if you were to predict that, man, you'd be psychic and I'd need you on my team. So, you can't really time the bottom. Don't ever try to time it because you know what they say, time in the markets beats timing the market. Third, you don't want to chase these risky plays. Now, you want to avoid these meme stocks, these YOLO options, and speculative bets. I've got my fair share with meme stocks and YOLO options and these speculative bets. They never really turn out well. If anything, you probably have more fun going to the casino because you actually get the dopamine of hitting a button and actually get to see the money pay out to you. However, you don't want to be chasing these risky plays. This is guy riding this wave down. That's what we want to be doing. But we want to be happy instead of frightened like this guy. You see Jerome Powell, he's spreading the salt and, the stock market's going down. We want to be happy when this happens. Next, how much cash do you really need to keep? This is our dry powder strategy. Though you can't see the dry powder strategy on the right side. But you want to keep 10 to 20% of cash in your portfolio if you are a long-term investor at all times. If the market crashes, if the market corrects, the market comes down, you want to buy back some of those companies that you saw so much value in. Buy back those ETFs, buy back the market, buy back the S&P 500. And if you have no cash, no dry powder, you won't be able to. So make sure that you're keeping 10 to 20% of cash if you're a long-term investor. Now, on the flip side, and if you actually are anticipating a major market crash and you want to buy in big, I would say keep 25 to 40% in cash. You never know. If you are so convicted and you have such conviction that the market will crash in the next year, the next 2 years, or the next couple months, why not have so much cash around if you truly believe it to capitalize on the opportunity? In addition to that, you want to keep 5 to 10% or less in cash if you're aggressive and want to keep investing regularly. You want to keep your time in the markets, right? So every single month, every single day, every single week, we want to be buying stocks. We want to be buying ETFs that track the market. And I understand if you have this automated and you have this schedule of investing, that you might not have enough cash to lie around. Now, you want to be like this girly pop over here. She's holding a stack of cash. She's ready. She's ready for the market. She got the diamonds on here. If need be, she could liquidate them. Not as fast, though, as cash. But, you get the gist. She's holding all this cash. She's ready to put the money into the market. Now, I'm going to read this little quote here. Cash is not just for safety. It's ammo to buy when stocks go on sale. We know when stocks go on sale, that's the best times to buy them. If you go to the store, you go to a shopping mall, and you see a 20% off, you're going to jump on it. But when it goes back to full price, would you want to buy it? That's the exact same way that we should be thinking of stocks. When they get a haircut, when they get a discount of 20, 30, 40%, why aren't we hopping on them like it's Black Friday in 2017? Because yeah, I'd be pushing people, I'd be shoving people to get my orders in and fill in those orders and put as much money as I can into the markets. What we should be doing with our cash. Next, where do you want to store this dry powder? This dry powder known as cash. There's 3 places that you could probably store this that would get you the best yield for your money. Number 1, we're going to put the money into a high yield savings account. That's a HYSA. Likely nowadays, you'd probably get anywhere between a 4 to 5% APY on your money, meaning that every single year that you put your money into that HYSA, the high yield savings account, you'll be getting that 4 to 5% back on your money. Next, you want to put your money into Treasury money market funds. Now, there are some ticker symbols I listed here, SGov and FDLXX. These are tax efficient strategies that you can use if you are living in a taxed state for income tax. If you notice here, this high yield savings account of 4 to 5%, you will get that nice yield. However, you will have to pay state taxes on that money. If you go into these Treasury money market funds, you don't have to pay state taxes, but you do have to pay government taxes. And in the high yield savings account, you're actually taxed on both ends. So you want to make sure that you're getting the most tax efficient strategy that you can. And in short term, there's T-bills. These are 3 to 6 months long that you might need in a emergency, 3 to 6 months. You don't want to keep it too long, but you don't want to keep it, too short either, just in case you need that money to deploy it back into the markets. Now, you might get higher rates for these, and these are pretty safe. I use this Fidelity Treasury Money Market Fund. This has been able to get me 4 to 5% on my money throughout the years, and I just keep my money into this mutual fund. I buy it and I hold it. That's my dry powder for my cash if I ever see any good positions in the market to buy. Next, what do you need to do now in order to prepare for this market crash? You got to have that cash ready. You got to buy stocks when they drop, keep that dry powder on the sidelines, have that wallet open for whenever that market does crash. You need to get in there when the market does crash. Keep in mind, cash is good, but cash too much is not able to capitalize on any opportunities. You want to focus on the quality. Focus on quality stocks. Focus on quality ETFs. Now, you want to buy these blue chip stocks that are going to be defensive in sectors, or you can go against the grain and be a contrarian investor. Buy quality stocks, companies that are doing well, companies that have increased profits, increased free cash flows over the years. And with that, it's kind of hard to see a company fail if they're increasing revenues, increasing cash flows, increasing the income statements at the end of the day. The more money they bring in, the more money that goes into your pocket as a shareholder, the more value that gets returned back into your pocket. So focus on the quality stocks, focus on the quality companies. That's all I got to say for that one. Diversify and hedge. If you're scared, if you're over leveraged in one aspect, one sector of the portfolio, let's say you have 80% of your portfolio into tech, you might be in for a rude awakening if tech does sell off, because the market does seem to go risk on or risk off at some moments now. So other alternatives, you can put your money into other sectors, or you can buy stuff like bonds, gold, and keep your money into cash. These are pretty liquid, as I'd say, and you'd be able to deploy that back into the tech companies that you'd like, or back into the stocks that you like, just because they get a 20% haircut. So you can also do that as well. Next, you want to dollar cost average into some strong stocks. Ride out the volatility. We see companies like Google, Amazon, and Microsoft, Apple. They've been doing well for the past 10, 15, if not 20 years. When we see a 10, 15% crash, we get scared. We get nervous that the markets aren't going to do well anymore. But take a minute, zoom out, look at that 5, 10-year all-time chart. You would see that if you had ridden out the volatility, you'd be okay. Next, you want to increase your income streams. Now, look at these side hustles, these dividends, these passive income strategies. You want to get different jobs. You want to have another job because, if the market were to crash, that means that there's a potential that the economy might not be doing well either. We could be in for a rude awakening in terms of the job market. We could be losing jobs. It's scary out there sometimes. You want to keep hustling. You want to keep growing that bread. You want to keep bread stacking. And next, we're going to look at this case study. Look at the past crashes where there are opportunities. Now, if we look in 2008, there's been a crash, and buying these great stocks such as Apple and Amazon made people rich. In 2020, during the coronavirus, we saw a huge dip. We had a huge recovery after that. Now, if we learn anything from these times, it's that every crash is an opportunity in disguise. We look at Amazon. I'm choosing this as an example just right now. In 2007, when the stock market was pretty bad until today, If you had bought in 2007 and held till today, you would be up 2,900% on your money. That comes out to a 22% annual year rate of return. We know that the market, the S&P 500, only really gives us 10% back on average. You buy the great companies, you buy the great stocks when they're on discount. Anything on discount that would have done well back then. You look at a different time frame now, from 2020 to 2025. That's only a 5-year holding period. You'd be up 93%. Now, 93% might not sound like a lot to you if you've been investing recently and you've seen the huge booms and huge lows of the craziness out there. But 93% is a very, very good rate of return. That's annualized at 14% per year. Market's only getting 10%. Remember that. So you look at these big drops here, these big small drops, big and small drops along the way. They scare us. We don't want to get in the market. We're scared. But you buy a quality company like Amazon that's getting into the business of AWS, shipping your boxes, drones, self-driving cars, all of this under that guy that started the freaking bald dude Bezos that made another person rich just off a divorce. Who knows, right? But buy quality companies. You zoom out and keep buying the dip, like I say here. If you zoom out, you're able to capitalize on these gains here. That's pretty much all I have for you guys today. That's what you guys want to do in a stock market crash, or if we go into recession in 2025, make sure that you guys are stacking your bread and that make sure that you guys are capitalizing on these buying opportunities, because when it gets scary and when there's blood in the streets, that's when you want to get out there and get as much money, as much assets as you can and deploy all that money into the markets. Stay calm, follow the plan, and you'll come out ahead. Now tell me, what's your possible strategy for this 2025 crash that we might enter? Now comment below. Thank you so much. Have a great one. Peace.